Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, let's get started. So first is, this class we need to just do several things instead of the regular lecture. First, I want to just tell you what's the answer looking like for the midterm. It's because it's over 200 sheets, so I haven't finished marking it yet, but let me just give you the answers. And actually, first, this should be just 3 points. This was a mistake, 3 points each, so that they adds up to 100. Okay. And the multiple choice. First question. Can you guys see, or should I make it even bigger? Like this? Better? Okay. So which of the following are debt instruments? That's very simple, right? So it's a fixed payment. So first, U.S. Treasury bond, yes. Corporate bond, yes. Corporate stock, no. Municipal bonds, yes. So the correct answer will be A, B, and D all together. So it's E. Right. Now, second question. Any question? If you have any questions, stop me anytime. The second one, common stock issued by the Smart Biz Function Corporation is traded in which of the following market? So it's a stock, right? So it's not a money market, not a debt market. It's an equity market. It's on capital market, right? So it's C and D together. Third question, the principal economic function of financial assets, including So transfer funds from those with surplus to those who need funds, this yes. Reallocate the resources for the most efficient usage, yes. Redistribute the unavoidable risk associated with cash flow generated by tangible assets among those seeking and providing the funds, right? And gathering small amounts of together for investment with scale. That's the last one is pooling. So it's all the above, right? So the first one is transferring, reallocate resources, redistribute or diversify the risk, and the pooling. So it's all of the above. Now the fourth question. Which of following are type of investment company? And so investment company, remember the investment open-end, closed-end funds, they are all investment company. Unit investment trust, yes. And so all these three, or A and B, so it's the D, all of the above. So which of the following is a depository institution? Depository institutions are financial institutions that can take deposits, right? So credit union, yes. Mutual funds, no. Insurance company, no. Commercial banks, yes. So it's A and D together. See? Any questions? Good, okay. Question 6. Which of the following is important to prepare RMB's internationalization convertibility? Okay. So overseas trading a cleared bank for RMB, yes, that's important, one of the three pillars, right? Cross-border investment channels for RMB, that is also important. China's economic dominance in the world, it's not necessary. You don't have to be a dominant economic, right? So a lot of currencies are international convertible, like Australia, Japanese yuan, Singapore dollars. They're all international convertible. But they are the economic and it's not necessary dominance in the world. So it's A and D only. 7. An investment bank involves the following business. Remember the investment bank has three business, right? Underwriting and the merger acquisition and the trading. But in the trading, they have both the trading for themselves, act like a market maker, or they're trading for the clients as a broker, right? So it's basically underwriting, merger acquisition, market trading for financial products, brokerage service. So it's all of the above. Clear? Good, okay. Question 8. Which of the following statement about GDP is not true, right? Productivity growth increase GDP, yes, correct. Population growth increase GDP. Given if everything else, the productivity is the same, the labor goes higher, so your base is large in GDP goes up. So the second is, yes, stock market performance does not reflect the past GDP growth. That's correct, right? Stock market performance could not reflect the future GDP. This is not true, right? The stock market could reflect the future GDP. So the D is the incorrect one. The others are correct. Question 9. Which of the following statement about productivity and capital input? Again, it's not, which one is not true? Sudden increase of technology increase productivity. That's correct, right? Second, when capital supply increase, marginal output capital increase. Is that correct or wrong? Remember the productive output line? The slope is going to coming down. When your capital supply increase, the marginal output or marginal return of the capital is going to decrease. Right? This is for most of the production function. They have the decreasing return on the input. So B is incorrect. The rest is correct. For given capital, countries have more advanced technology, has higher productivity per worker. Remember, because it's basically your productive function divided by labor, which left with A, which is productivity, and then the capital, right? So if you have capital fixed, then your technology increase A, which increases productivity per capital. High level of capital in the industry leads to low returns to capital. That's correct, right? Decreasing return on the factors. So the right answer is B, because it's looking for a statement that is not true. Okay, question 10. Which of the following factors are important for investment and growth? Which is political risk. which is important, right? And the information disclosure rules, that's talking about the transparency and and investor protections, that's good. C, legal protections, that's also important. So the correct answer is all of the above. Any questions? Good, okay. Now, question 11. Which of the following are not considered as good investment protection? So it's not considered as good investment protection. One share, one vote, which is a good protection because that limits the equal voting power for the minority shareholders. Second one, block shares before shareholder meeting. This is not good because if you block the shares before shareholder meeting, you limit people's voting power, right, by limiting their trading ability. C, senior credit get paid first. This is obviously by legality or the contract, senior creditors will get paid first, then the junior creditors, then the equity holders, right? The remove manager in reorganization process, that is also a good protection, right? Once the firm go into bankruptcy, you don't let the manager still take control of the assets so that they might actually channel out or etc. That will hurt the creditors' rights. So all the good protection, which so the B is the right answer. 12. Which of the following is not a component of country's balance of payments? Remember, the country's balance of the payments, including current account, right? That take control of import, export, etc., and a capital account that takes the inflow and outflows through investment, particularly the capital market investment. And then trade deficits, which will be one's type of or the status of the current account when it's in the deficits. And foreign direct investment will go into capital account, right? So the one not correct is the fiscal deficits. The fiscal deficits is the government's balance, which basically is the tax revenue that goes to the government, and then the expenses of the government, whether they have surplus or deficits, right? So it's not the balance of payment, it's the government expenditure. Clear on this one? Okay. Now, question 13. Which of the following are determinants of foreign exchange rate? Remember, the foreign exchange rate is related to the payment or the demand supply of the currency of your own country versus another country, right? So it will be related to trade deficits. If you have a lot of trade deficits, that means you are buying more products than selling, so you are paying out more of the foreign currency than receiving, right? So that will increase the demand of foreign currency. That will increase the foreign currency price or depreciate your own currency's price. Interest rate, this is through the interest rate parity, right? If your country have high increase in interest rate, you attract the capital inflow. That affects the demand of your own currency. C, inflation, that is through the purchasing power parity that affects the foreign exchange rate. D, productivity, right? So through the productivity, you will be able to influence the price of their products because through the reducing cost or increasing cost, etc. So all of the above will affect the foreign exchange rate. Now, 14, which of the following has contributed to the euro crisis? So the euro crisis, remember, we basically talk about two big things, right? One is the structure or the setting, how the euro is setting up actually is going to doom for this currency is going to have constant crisis, right? The fixed structure is those countries have very different economic status or productivity, but they have the same currency. And at the same time, they have the different government physical accounts, right? That's the three important things that cause the problem. So we're looking at which of the following has correct here. A unified currency system for countries with different economic situation. That's correct, right? That's the part of it. A unified political system for countries with different economic situation. This is not correct because it's not a unified political system. If it's a unified political system, become one country, they would have sharing the same physical accounts, right? That actually would solve the problem. Now, see, independent physical policy, that means each country different, with non-independent monetary policy. That's correct, right? So its correct answer is A and C. So it's the D, A and C here. Question 15. Which of the following policies may help an economy to get out of recession? This is where we explain why, if with that euro setting there, these countries that are doomed to fail, right? So where we explain is the policies that can help the economy get out of recession. So if the country in a recession, what do you do with the interest rate? Decrease, right? So make the funds cheaper, encourage investment. So the first one is wrong. Second one, expand the government-funded project. That is correct, right? You increase the government investment, and so the money will go into the circulation, and then people receive salary, etc. Then the demand goes up, the whole cycle goes. The depreciated domestic currency, that's also correct, because when you depreciate your domestic currency, you make your product more competitive on the international market, right? And then that is going to increase the demand of your product, increase the industry. So the correct answer will be B, and C, that's E. All good?
But when we increase interest rate, we will attract more maybe investment from overseas.
You might, but you may not, because if your economy is in the recession, that means the people, investors view your economy has low return, right? So interest rate alone may not be able to attract enough investment. Unless you can only people coming in. So here's the thing. Now, when you have high interest rate, thinking about what happens to the return of the financial products on the market when you increase interest rate. So basically, you're going to see the treasury bond interest rate increase, right? And the corporate bond interest rate might increase as well. And general equity returns interest rate supposed to increase, but to meet this, all these increased return, what happened to the price? Price actually decrease, right? Okay, and this is a time in the recession, the price decrease is people have low expectation of the future growth, right? So when the foreign capital, in that situation, when the foreign capital decides whether I will go invest in that country, what will come into their consideration? They can either buy, if they can buy treasury bond, then their concern is whether that country will be able to pay the government bond back, right? Or if they come to invest in the more risky assets, corporate bond or equity market, their concern is how the future economic performance is, right? So their risk part might also increase. So that means when they see the risk increase, the higher interest rate may not necessarily attract them to come because they are taking higher risk as well. So that would not give you a clear answer of what may happen. Clear? Okay. Now, question 6. Which of the following condition is not necessary for a country's currency to be globally accepted in trade? This is, again, sort of international convertibility, right? So the statement is not necessary. Which one is not? The first one, the country is politically stable. it's necessary, right? People have to trust that currency. They have to believe this country is going to be politically stable. Second one, the country is the largest economy in the world. It's not necessary, like the earlier one said. The country is a large trading partner for many major economies in the world. That is also it's also part of the necessary, because otherwise, if the demand on general on the world on this currency is small, people don't want to or take holding of this currency, right? Because it will be much harder for them to get rid of. The country has good sovereign credit. That's also true, because they have to believe the country can honor the payment or the value of the currency carries. So the right answer is B. It's unnecessary. The country wanted to be the largest economy. And I keep emphasizing this, you probably guys understand why I keep emphasizing. Because you see people talking about the China's economy these days, they like to say, we are so large, we deserve this and that. It's not true. It's not because you are large, you can't necessarily achieve certain status. So the political stability and the prospects of sustainability in the economy is much more important. Then plus the institutional setting of allowing the RMB to be traded or converted or flow in out of countries. These are actually much more important. Now, question 17. Which of the following statement about state ownership of corporation is incorrect? So it's incorrect. State ownership is a unique phenomenon in China, which is not true. State ownership is associated with inefficiency in management. That is, many evidence shows that. Political connection of CEO is not necessarily always bad for managerial incentive. That's also true, because sometimes the political promotion incentive actually give them incentive to work hard, right? That can be good for the managerial incentive. The political connected firms may underperform despite preferential access to resources. This is, again, many evidence shows. So the right answer is A. State ownership is not unique, right? So what we are looking for is the incorrect answer. So it's not unique. Okay. Question 18. Which of the following statement about family ownership of corporation is incorrect? Now, so first one. It is possible for the family ownership to be supportive to GDP growth. That's correct. We said we're talking about the institution supporting economic growth. The state-owned family could all be part of supportive one. Family ownership is a unique phenomenon in Asia. Again, this is not correct. In Europe, there has family ownership may trigger stealing from minority shareholders that we showed, right? It's possible the tunneling happened. Dividend payment could be a way to alleviate stealing. That's also, again, correct. So the right answer is B, which is incorrect, an incorrect statement. Okay. Now, 19. Which of the following about currency crisis is incorrect? Again, we're looking for the incorrect one. The first one, currency crisis is a type of financial crisis. Yes, correct. Currency crisis often happens when foreign capital flees the country. Yes. Currency crisis could be due to sentimental panic. That's also yes. Remember, the second generation of the currency crisis is self-fulfilling, right? When people lost the trust in that economy, the capital flow out and it triggers the currency crisis. Like that's exactly the Asian, the Thailand, etc. Not exactly Thailand yet, more like the Soros attack on the UK, or the Thailand combined some banking problem. The currency crisis is due to low investment. That is not correct, right? Could be low investment, could be over investment, could be any level. Currency crisis is accompanied with weak banking industry. This is also correct, particularly correct for the third generation, but usually correct in any situation. So the right answer is D. The currency this is an incorrect statement, which for this answer. Now, question 20. What does a conventional institution finance growth nexus mean? So remember, the conventional is believing you need legal protections, right? So, and then you develop the financial market, then the economy grows. So basically, the investor protection is important to develop financial market. This is correct. Financial market advancement supports economic growth. That's also correct. Economy can grow well without mature financial market. This is the pattern that we see in China. But this is not conventional. This is sort of a new finding, right? So this the conventional. What does the conventional mean? Is A and B, right? Questions on this one? No? All good? Okay. Okay. So these are the multiple choice. The next is calculation questions. Now, calculation questions, okay, actually, let me slow down to refresh you guys a bit. So if up to now, if you're looking at this course, you realize the fundamental basic skill you actually have learned from your past courses, right? From actually you have to put many courses together. It touches corporate, touches investment, touches banking, even touches foreign exchange trading. And in this course, we sort of you have to use all your basic skill have gained through other courses, start thinking about the macro topics, right? Particularly the development, how the financial markets and the economic growth is to understand the patterns around the world. Okay, so it's more like you have to use all the way of thinking and use the skill you have gained. So again, here, same. So the calculation question, I'm going to tell you several things that you have learned, but maybe when you're learning those courses, the professor didn't tell you how to, make sure that's consistent with the market or the typical when you apply on the market, what happens. Now, first one thing, right, for all the interest rate or the inflation, etc., unless they specially denote. Otherwise, the default is always annualized rate. For example, they say the 3-month Treasury bill return is 2%. It only means if you invest holding this 3-month Treasury bill, you don't get 2%. You only get 2% divided by 4 because it's a 3-month instrument, right? You effectively getting the did I say 2%? The 3 months, you get 2%. You, if I get it to 2%, unless you keep reinvest in these 3 months Treasury bills. And then it may involve, what we call it, compounding. Yes, you guys. So it might involve compounding, right? So all the rates quoted on the financial market is always means simple, nominal, annualized rate. Nobody is going to quote you an effective rate. Unless, like, for example, they write a contract of, credit card contract or something, they will write very clearly. The interest rate is this, and we're going to compound it based on daily or compounding on monthly. And they might or may not tell you then what will be an effective rate after the compounding. Is it clear? Is that clear to you? Okay. So so when you make the calculation, you need to be clear the rate is annualized rate. But how much return you're getting depends on your investment period. Okay? Now, here, the spot market of US dollar over Australia dollar is 1.33. The future market USD over Australia dollar is 1.32. Now, here, I could say the future market is for 6 months, but I didn't say it, is because later we all talking about only the treasury amount bill is 6 months. So that's the only way you can do it, which is the current future market for contract that expires in 6 months. Okay. Now, first question, what is the expected exchange rate between Australia dollar and US dollar on this day implied by purchasing power parity, right? So from the implied purchasing power parity, this is again an adjustment of inflation, right? So the inflation says what is the expected inflation for US coming is 3%, and for Australia is 2%, right? And then the actually here, expected. Here, actually, nobody answers this question. Oh, no, it's correct. So 2017 and 2018, yeah, it's 1 year, right? Right, so that means in the, right, so in this question, now, one thing you guys always get confused is which inflation goes on the top, which inflation comes down, right, at the bottom. That's it. Now, if we remember I said use the market convention of quotation, the US dollar over Australia dollar equals 1.3. That means the US dollar is 3 times more valuable than an Australia dollar, right? Now, if the country the inflation is higher in the long run, what happens to the exchange or the value of its currency? It's decreased, right? And so for this, it's very simple. You will immediately know you should put a smaller number, 1 plus 2% on the top, 1 plus 3% at the bottom, right? This is a tricky shortcut for you guys to think. That's why I said never need to think about direct quote or indirect quote or falling or something. Use your intuition here, right? So you know the inflation in US is high, so in the long run, its value is going to decrease, right? So you adjust this current 1.3, multiple 1 plus 2%, divide by 1 plus 3%, you get 1.317. Any question on this one? Okay, so the next question, we're talking about the implied interest rate parity. But because the interest rate, we only have give you the 6 months Treasury bills interest rate here, so what you're going to be able to calculate is the 6 months future rate, right? Implied by interest rate parity. So this part is going to, now, this is going to, again, remember, the way I'm writing it is not an exact formula, but remember, where does the interest rate parity come from? It's based on the principle that if the capital are free flow between the countries and there's no transaction cost or the political risk involved, then you investing in these two currencies should give you the same rate of return, right? Otherwise, the countries as a currency give you a higher return is going to attract more capital in, and then the price goes up, then the return will come down until they reach the equilibrium. That's the basic idea, right? The principle. So the way you're going to write, the way I do it is, so I will start to say, if I start with $1 US here, and I convert to Australia dollar, become 1.33 Australia dollar. Right? And then I invest in Australia for half year, 6 months Treasury bill, which the rate return is 2.5%. Right? So on top, Australia 2.5%. Then I will immediately right now, because I want to lock the rate to avoid the risk, right? I will convert back to the, sorry, I shouldn't have a 1 plus here. I don't think they need a 1 plus. Do I need a 1 plus here? No. You just directly multiple f. Or divide by f. Yeah, divide by f, sorry. Right. Then you convert it back to US dollar. For each Australia dollar to convert it back to US dollar, you need to divide by the rate, right? Because remember, Australia dollar is cheap. So this would be the total amount of US dollar you will have if you invest $1 US through Australia dollar now, right? Or if you can say 1 million, whatever scale it is. Or compared to another way of investing is investing in US dollar through the 6 months Treasury bill, you get 1 plus 2% over 2, right? So this is the principle. You're going to two investments is going to two way of investment is going to give you the same rate of return, and then you will get the implied rate is 1.333. Any question on this one? Go ahead.
Can I ask something about the interest rate?
Mm-hmm.
The interest rate given from the credit statement is the half year, right?
Uh-huh.
So what we should calculate the 1 year?
You can't do 1 year. You can only do 6 months. That's why you will get the 6 months implied interest future rate. So you divide by 2. You do 6 months. So this would be the future rate implied 6 months from today. On the current market, for the future contract should be traded on this one. Okay, so, but he has a question. I'm say a little bit just for you, if you guys understand as well. What you have in mind is you thinking, I'm having 6 months treasury bond here. How can I do a portfolio allow me to do 1 year investment? That's in your mind, right? For the question given here, practically, you cannot. Because it's the 6 months treasury bill yields today. And there's no information to give you what would be the 6 months from today when you need to roll over. Or you can roll over today by invest in treasury bill today and through a future market. But here, I didn't give you the future market of 6 months yields either. So you don't have any of those tools here. See, this is an application of calculation-wise, it's very simple, right? But to thinking about what you can do with it is you have to be able to relate to reality. Practically, what could be happen? Right. Okay, now third question is, in this situation, there will be an arbitrage opportunity. Why? Because the interest rate implied 6 months is 1.33, but the future current market is 1.32, right? So that's what that says. That says, so now here again, this is the advantage of without thinking direct quote or indirect quote, but give you very quick shortcut, right? That means if I do this on the market, oh no, not this one, sorry, this one. If I do this investment on the market with the actual available future rate, the two sides or the two investment alternative way are not going to give you the same return, right? Because on the market, this future rate is 1.32 instead of 1.33. Now, that will give you an arbitrage opportunity because if this is 1.32, what happens to the return here, total amount of dollar here compared to on the right-hand side? The left-hand side number is going to be larger than the right-hand side, right? Because you're going to divide by a smaller number. That means if I invest in Australia dollar, it's going to give me higher total amount in the end compared to invest in the US dollar. Right? So now if you think about arbitrage, where should you borrow money? Where should you invest the money? You're going to borrow on the US market, right? Because borrowing on the US market make you pay this amount by the end of 6 months. And then you convert the borrowing, whatever, $1 million US dollar to Australia dollars, and you are investing US Australia, and that will give you another amount, this amount, which is higher than this amount. And now, why do we call it it's a risk-risk arbitrage? Because the future market rate is available on the market now, right? The treasury bill instruments are available on the market. You basically can set up this transaction, whole transaction today, and lock with the future price everything in today. Right? So all the prices are available. So that will be the arbitrage. So if the market sees like that, you will see many people do the arbitrage. And then very soon, when that happens, if the arbitrage happens, what happens to the Australia dollar price? it's going to go up, right? Because people are keep borrowing US to convert into Australian dollars that increase the demand. And so the current rate of the Australian dollar going up, that means the US dollar over Australia on the spot market is going to decrease. And because the transaction is happening on today, people want the arbitrator want to convert back to US dollar with the future market rate. That means on the future market, they sell Australia dollar, buying US dollar, right? And what happens to the future rate then? For the US dollar is going to going up. So this number is going to going up, right? So when that happens, what happens when all these trends going on? What would happen to the amount of dollar on this left-hand side? The current 1.33 is going to become smaller, and this future rate 1.2 because the demand on this is going to go up. This will bring this number smaller, right? Until it reaches the equivalent to this number, the right-hand side. Then the market will be in equilibrium again. Okay, so this is basic. So now, the mechanism you understand, right? So how you do it, basic. So example is you borrow $1 million US dollars, and how do you borrow $1 million? You through short US dollar treasury bill, right? On the financial market, you short, you sell the treasury bill, and then you convert them into the Australian dollar, getting 1.33 million Australian dollars. Then you enter a future contract. How much you want to sell for the future contract? You want to consider the 6 months treasury return, right? This is how much you're going to get in 6 months, but you're going to actually enter the future contract now so that you can lock the price to get your investment risk-free, right? And convert it back at the 1.32, the future rate, you get 1.02015 million US dollar back through whole transaction. Then in 6 months, you need to pay the US dollar loan, which is this amount, 1.01 million, right? So the profit for each 1 million of US dollar transaction you do or contract you enter, the notional value, you'll get 0.011, which is about 10,150 US dollar profits. Is it clear now? Okay, so this is a question, like practically on the market, this opportunity actually often comes on the market with the rate maybe very small and it disappears very fast as well. But it's actually often on the market will appear. Okay. Any questions on this one? Now, question 24 to 27. So this is based on the very simple measurements of the calculating the financial market development, right? The total size of the market compared to the bank, or the relative size of the market to the bank. And even if you don't remember the formula, I'm giving the hint of sum both bank market size in log value. Right, so basically the hint is right here. And so what is the financial size? Financial size is the sum, right, of the market and bank together. So it's a sum of the log value. So just plug in the bank credits scaled by the GDP or the market scaled by GDP. It's very direct. And even if you just have this without the final number, you're going to get the points anyway. Okay, as long as you can write this down with a hint, you're getting 2 points. This is really how should I say this? This is really like a gift of credits, right? So either, and even if you're using log 10 or using natural log, either way you get the same. You will get credits anyway, because I'm not examining your way of using calculator. I just need you to understand what they are. What is finance activity? Activity is basically you change the market cap to the value traded. Right? So the log of bank plus the log of market trading value, or scaled by the GDP. Right. What is, any questions? Okay. Now, so maybe you have a question is why do we want to scale by GDP? Intuitively, what do you think? Why do you need to scale by GDP? Because if you have a very large economy, naturally, you should have a very large market, given if the same level, a large country and a small country, if they have the same level of financial development, in the country with a large economy should naturally have much larger banks and markets, right? So, but this same level of development can be shown up only if you scale by GDP. Otherwise, if you don't scale by GDP, you just capture its size of the economy rather than the development of the market. Okay. Now, the finance activity, the next one is what is structure size? The structure size, structure means the market relative to the bank. So it's no longer a sum, but like a minus. Basically, it's relative, so it's mass, right? You have log MC by GDP of GDP minus log of this, which is equivalent on the slides. Remember, if you have minus log, you basically have log of this divided by this, right? It becomes log of market cap over bank private credits. Right, so it will be same as the slides, but even you don't, the hint will give you this. And then what is structure activity again? Just the log of the value traded of the private credits. Any questions on this financial market development? This is really not much there at all, right? Okay, so the last three questions is on the cash flow and stock market changes, right? So this is very similar to the one we did on the quiz. Actually, maybe simpler because the quiz I was asking year 2 here, just 1 year, right? Now, expected GDP is 3%, equity requirement 8%, free cash flow in 2017 is 96, right? So what is the price, which is basically just apply this for for the current year? You get a 96 the current multiples, expect growth 3%, which will be 1 year from today. What is expected flow, which is free cash flow at T plus 1, right? Divide by expect return 8% minus growth 3%. So you get the price of this. Now, this is question 9. Suppose the economic condition in the first half of 2018 improved and the analysts revise the forecast GDP growth also remains 3% in 2018, but will be 4% from 2019 onwards. What will be expected value at the end of 2018? At 2018, the free cash flow T plus 1 will be 2019, right? So it will be the 96 plus 1 3%, which is at the end of 18. Then multiple 1 plus 4%, which will be the free cash flow at the end of 2019. And then you divide it by the end of 2018, your expected future growth it become 4%, right? So you apply the formula again. This is simpler, much easier than at the quiz, actually, right? So so you got the price of 2018, end of 2017 and the end of 2018. And then the third last question is, what would be the total stock return if an investor buy at the end of 2017 and hold until the end of 2018? Right, it's the capital gain plus dividend. The capital gain is the price difference, and the dividend is the free cash flow of that end of received in 2018, and divide by the initial purchasing price. You get 35%. It's simpler than in the quiz. Now, one question at the quiz people often asking is, why the free cash flow is dividend? Now, this is, again, you should have known from your corporate finance. This formula, where is it? This formula is Gordon model, right? As you have learned in your corporate finance. And if you have run it correctly and you really understand it, how do we get this formula? It's basically saying the current stock price should equals to all my future received dividend discounted, right? And what was that dividend? It's the free cash flow. So that whole Gordon model is based on the way of how corporate does is a payout of the free cash flow, right? Therefore, that's the dividend you're going to receive. Any questions? So in this course, thinking about what we are doing with this question is basically, the Gordon model you have learned before, you should already know. All we are doing is applying the Gordon model to understand how the stock market move around, right? So apply to the reality. And instead of apply to one particular company, we just apply to the whole economy. And if you understand this course much better for each of, because in our course's application, I still simplify a bit, right? And then in the reality, you will see every quarter that the company stock price may move, right? And that's why around the earnings announcement of the corporation, you often see big movement right before or after the big movement of stock price, because that's where they adjust their expectation. The new information arrives. Good. Okay. Any questions? No? Okay, then all good. And so the next thing we will do is I'll give you short of time. Anyone have questions regarding the project? Because I have several people coming to the office start or email me about the project guideline. Do you have any questions?
I have a question. For question 21 and 22, if I do the correct formula, but the calculation is wrong, can I get some of the marks?
Yes, you'll get marks. Yeah. The right formula get 2 points. Plugging the number is getting another 2 points. Yeah.
For the question
Oh,
21,
21.
my denominator and denominator is the adverse. So
You mean here you have 1%, 3% switched? No, then you're not, because basically you get it long even. And then it will be also wrong, because you are assuming 1 year, you don't get 1 year. This might get 1 point. I have to double check what I told the marker. You might get 1 point, but I have to double check with her. But I think it will be longer. Okay, any questions on the project?
in the project, we just read the article and find information in the article. It is necessary to find out more information.
You mean the articles, the handouts I give you?
Yes.
Well, that will be very limited, because the project, the article give you is giving you the background and some their own analysis, right? But the project, the case, the objective of the case is you have to develop sort of like almost like a business plan or suggestion proposal given that background, right? So if you're just using the article information, it's limited. But of course you can do it, but it's very limited. It's sort of you're only adding value is sort of doing a bit more logical reasoning with the current information.
And in the assessment, is compulsory requirement we must have the real value in each scenario. Maybe we just state.
You don't have to, but if you can do it, it would be much better, but you don't have to. It's a continuous assessment. It's not a 0-1. Right? So each group will have the analysis done to the different degree. And the final grade marking for that project would best on your logic, whether you clearly, the logic reasoning, the evidence, and whether you put your argument clearly, your exposition of writing.
So just talk about the material, the case study. Because based on our own research, we find I couldn't see the conflicts and some difference based on our own research and case study. For example, the international extension of the international business of Lufax. Based on this case study, it seems that the international business is good, but based on our own research, we find currently the international business does not perform well.
Okay.
And
that's perfectly fine. Because remember, even the case study writing, you should always, your mind tell me, is this telling me something facts or it's something telling me opinion? Right? So that's where you need to, even if you find the information, like the same people who find the same factual information, but the analysis might lead to different opinion. You can always write your own opinion. But the important thing is you have to have a clear logic of why you're leading to this. And then you provide evidence that supports your logical conclusion.
So actually in the article, they don't mention anything related to international business. They just say a little information that Lufax tried to maybe set up overseas business in Singapore.
already.
Yes, already. And no information that it did work well or not.
Okay, so the case will be exactly another sort of training. For the whole this course, it's really training your mind of thinking. It's the thinking you need to require to do. It's different from the other course. Right, so there is no definite answer of yes or no, or good or bad. And you could have two projects that give me the same opinion, but one I might mark very well because it provides very clear evidence and the logic reasoning of the thinking analysis, while the other one didn't provide any of the support evidence. They can get different grades, marks. Or you can have projects who have complete different opinion. One tells me that this Rofat is the business is growing, going to be at 10%, 20% or dominance, or another analysis tells me that it might fail, but they might both get good marks as long as both of them provide the sufficient evidence to show the logic.
Another question is about the word limitation, the page limitation. Now, page limitation is compulsory.
It's not necessarily compulsory. I'm suggesting you don't write more than 5 pages. But if you're going to have evidence supplement with like graph stuff, it's going to take a lot of space and you can't go over. But I suggest don't write too much. It's thinking about someday when you go to work, your boss is not going to have patience to read long reports. And that's why also I suggest you on the first page have executive summary. Your boss are all very impatient. They read the first pages. Okay.
For our assignment, do I need to take some of the more research for the quantitative data to support our strategy or recommendation is efficiency or not?
It's your choice, up to you. Up to you. So this again, so the report there is no definite yes, no, you have to do this. All I'm saying is it's a way of your thinking, the analysis you do. And you can using numerical, you can using logical, you can using industry comparison, right? You can using the other example as experience reference, anything you can use, yeah. No, you're not going to lose marks because of too many pages. But you may lose marks that you write a lot, and then you want to fit into 5 pages, you make it very small, almost unreadable, right? This will be the poor exposition or the clear, not clear category. The best way for you to assess yourself whether you are happy with the report is put yourself as if you are a boss, your subordinate is giving you the report you are doing, right? And you are the boss of this low facts you want to understand, gain more insights from you. And then is it a report that you are happy to read? Do I learn a lot of things from the information? You can always self-assess. This is going to be an ability you need when you go on the work. An ability to assess yourself and be reflective. And I'm just using this case to give you the guideline and then give you the practice and give you feedback. Go ahead. Information from there, right? You would have to translate it if you're going to put in the report, right? And in your reference, of course, you can refer to this website, but the information you present have to be in English. Go ahead. What is the APA? Okay, whatever. The key thing is, I think you are talking about some reference format, right? Doesn't matter, as long as you acknowledge. Yeah. Okay, all good? Okay, let's see. We can continue going or we can take a break. Let me think. Let's take a break. Let's take a break, and then 20 minutes, then we come back. Next one.
Our team has only 4 members. Is that
That's okay, yeah.
Sir, can you upload your exam?
No.
Okay. So for final exam, still
Something, same, yeah.
maybe still short.
No, sure. Same, yeah.
And for the report, after I read the material, and I think a lot of aspects to think of, and maybe series have in the report it's a limited paragraph, or should maybe choose some of the aspects or just give a summary of each aspect.
What do you think? Like I said, I have no correct answer for the report. I'm just not looking at your contribution of doing this report. Does your report give any strategic value?
Sorry, one question about the project, group project. In lecture 3, sticking to the last slide, it says that one of the things we need to do is an assessment. So is it an assessment of our recommendation?
Yes. So you, for example, you recommend this expanding to Singapore internationalization, right? When you make this recommendation, you need to have, first the evidence showing this is good strategies, and also assessment of if you enter this market, what it has. That's my suggestion.
Oh, okay.
Yeah.
My other question was, so one of the things we're asked to do is identify challenges that we face. Is it enough just to list the challenges and then have anything explaining what the challenge is, or should we do that and then have like an explanation, not an explanation, an example of when they occurred?
Those should be as short as possible because it takes space.
Okay.
That's fine. Our group review the objectives, and the question is we need to focus on the strategy, building strategy in the next 3 to 5 years, or the 5 to 10 years, or both.
You
Which
can
is
do
more important?
You can do both and choose a focus, or you can just do one. Up to you.
So do you mean that this one is maybe an important one, and maybe less 5 to?
I don't mean you can make your choice,
Yeah.
and your choice have to be consistent with the analysis.
Yeah. And if you use some data analysis such as, you may use the graph.
Yes.
And graph should not be included in the passage, or it should.
That's the end of it better. Or it doesn't matter. You can put with passage text. That's your choice.
If you put the pictures of graph as the last page, should these include in the total pages? Okay, thank you.
Just ask, if we come to the conclusion, can we ask some specific question about our report?
I mean, it usually should be okay as long as the question don't make me a team member, because then it will make it unfair to the other team.
Okay, so
I can always give guidance, but I shouldn't tell you.
So what about some question like the specific strategy in the recommendation? Could maybe we are a little confused about it to be reasonable or
I can, if you ask a question like that, I will give you a guideline of how you think about this question.
oh okay.
I shouldn't tell you this is good or bad, because that will be decision making.
Yeah. Okay. Thank you very much. So will you be available after this?
Yes.
Okay. Thank you.
line? Okay. How do you match this to this?
Each aspect we will analyze the rate of change
Yeah, but that will be just a repeat of the articles background information, right? You do the objective. So basically what you're doing is up to here. What is with the rest?
So we need to give him a new plan beginning form.
Something like that. Yes. Because what you're doing is basically a repeat up to here, and up to here is the article already provided, right? And you're just doing a summary. There was no analysis.
According to this, we in terms of three aspects, we propose each business plan for various aspects.
Also, what she's saying is your business plan is also going to talk about three. This is not a business plan, it's probably a technique that you use for each area.
Yes, in terms of three aspects,
Okay.
we propose.
Okay, then but would it form a good business plan? You're talking about three different aspects. Are they working towards each other? Is it a good strategy? You are looking at each tree. But don't forget the whole forest.
So we should combine together.
I mean, doesn't mean structure your writing combined together, but your analysis should work for each other.
I see.
Okay, let's continue with the class, and I will talk to you about, because this is talking about reality a lot, so we're going to show you something with jobs in the industry. Okay, and this is something actually have done long time ago, pre-crisis, so things may change a bit, particularly salary might increase a bit, depends on the country's economy situation. And so here's us US data about maybe right before the subprime crisis happens. But overall, it will give you, best you can learn maybe several things. One is, all different type of job as a finance major when you graduate, what you could do, and one, that's, on different areas. Second is the career path in each type of industry. And then when I mention, I can add a little bit when the fintech comes, what might changes, right? So the first one is in the commercial banks, right? The commercial banks typically at the entry level, at a bachelor degree or master degree, that you might have a training or credit analysis job. That would be the credit analysis of, company when people have loan applications, you're looking through. This is the back office. The front office calculates this, there's also cashier, essentially would be the guys, the people that you haven't seen. But at the back office, when people make the loan application, you will help them fill the information, and you sort of make a recommendation of whether this applicant could be granted a loan or not, right? That's a very basic one. And then the next level, when you have some experience, you might move up to the junior loan officer. The junior loan officer can typically making like very small loan or routine. Like very clear, once the person reaches this standards, you can grant a certain amount of loans that the bank probably already have a convention on this, right? The junior loan officer can. Then the loan officer have been more experienced, the loan officer, that we're looking at, much slightly more individualized cases, the different information, or loan size relatively larger. Then going up even further, we have the senior corporate loan officer. This is US dollar amount pre-crisis. Right now, I should at least add like maybe 20-30% of increase to the salary amount. The senior corporate loan officer would be the one who actually have to oversight all the corporate loan that are being approved. So some of them might have been recommended by junior officers, but then eventually the corporate loan officer have to approve it, right? And then so those are usually the loan officer dealing with individual person or individual corporation on the loan application. Now, then there's mortgage originator that will be more on the dealing with real estate lendings, right? And then the financial analyst and personal banker, those are very, like the loan originator or financial officer or personal banker, they are very much like the junior loan officer, plus or minus level to the loan officer level, but except that they were dealing with like the real estate or dealing with the wealth management product, essentially. So these are the on the commercial banking. So you guys haven't had much experience, but you might take in one of this job. Your parents must have had this experience. For example, if you're considering buying the wealth management products, it often goes to the personal bankers. That's right. Okay, so these are the careers that can be in the commercial banks. And you can see over the times, the experience and actually are very important when you're moving up. Now, the insurance company. Remember, one of the jobs you guys all know is being the actuarist in an insurance company, right? So even in the actuary, there'll be entry level and then the senior level, right? And the salary actually very big difference. The senior level, the entry level actuarist usually dealing with much relatively small, those type designs, smaller product, insurance product, while the senior ones probably will launch those much large-scale ones. Then the agent broker will be the sales. Usually we hear of the salespeople, right? That they call it agent or broker. And then claim adjuster is where the people, if you have accident or anything, you will make a claim, you call the insurance company. These are the claim adjuster that, of course, first the customer service, that behind the customer service are the claim adjusters. Then the underwriter. The underwriter is, how should I say this? This is like an agent or broker who sells, but except he has to be the person who kind of approve it. If you meet a insurance sales agent who tell you about the contract, what it is like, he fills the application, then he bring your application back to someone, it's the underwriter who is going to look at it over, then finally approve. Okay, so this is an insurance company, that's the career could be like. Now, actually I'm missing one big part in the insurance company, the career like, is the investment side. Remember when we talk about the insurance company business, they have a large component is the investment, right? So the investment part will be very similar to the investment company such as not this part, but we later on, okay, let's not talk about here. The portfolio manager such as the financial analyst, right, and the fund manager, and the chief investment officer, etc. That's what we know. So now the only investment banks, what are the career, right? So you're going to have the first year analysts, like then 30 analysts. So those are the one sort of, how should I say this? It's the entry level in the investment banker, and it's usually very competitive to get in, right? And they might actually, from here, they might have like a intern or training to start even before that as well. Right? And then among the intern trainings, they select their first year analyst going onwards. But typically, if you see the investment bankers, even as entry level, the salary is usually relatively higher compared to the entry level in the insurance company or the commercial banks. And that's why it's also much more competitive to get in. Right? And then all those analysts, so once you go through the analyst stage, the next stage is called associate. And the associate, you can see the salary is already much higher, goes up, right? And then the VP. And for people who have MBA degree, then going into, they work a bit, then they're taking their MBA, and then they go in invest bank. Usually, if they're doing well, in actually 2-3 years, they might actually already move into VP, because this is like almost title inflation, right? And then the director or principal. Now, this once you go to the director or principal, these will be the type of people who can actually take in charge of a project. For example, the investment bank are doing underwriting business, right? They bring a company to IPO. The person would be in charge is typically coming to a director, the principal who taking. They might have a couple projects in their hands. They might report into a manager or a partner. But the director of business would be oversight by this director or principal. Right? And the managing director or partner, they might have several directors underneath them. And so each of those projects, the director principal taking care of a project, then the performance of that project would be benefits all the whole team, which coming from on the top, coming to managing director, bottom the VP, which will be, the VP would be a person who actually special focus on one project at a time. And under the VP, he might lead several, he have to coordinate with those analysts and associates. So now pretty much you can see in IPO team, who would be most likely to meet, right? The company, most often, the financial officer might meet the director and principal often, but the managing director wants probably in a while, more in establishing the business to ensure that they are taking care of the things. right? And so then if you're looking at the investment bank's compensation, they have very high components of this performance compensation linked or bonus. And those bonus often coming from the profits they're making through those projects. That's why, so the big hurdle of the analyst, associate, or VP maybe sounds relatively senior, but the biggest step is go from the director to the managing director, which is some people who might stay at a director never going up this, because that's the part where whether you are able to bring profits to the company. Some director might be in charge of the, this is again also the career, even in the same investment bank, which division you are. Some division might actually, for example, if you're doing IPO or the things you have, or merger acquisition, you have much chance to making high performance, right? But if you are in the division taking care of broker, in clients trading, etc., there's not much profits other than the brokerage fee coming in, right? And those are the way makes the difference whether people eventually moving up to managing director or not. And also how big as compensation, the bonus is. Okay. Okay, so these are the investment bank ones. So this is most competitive. And a lot of these fintech, when people are now worried about how the fintech in the impact, is often worries about those, how we say it, actually I think would be more worried about this middle part. Because the entry level, the basic manual work, you still need people to do it, even to managing this, right? But then the synthetic or pulling this information together to leading to basic conclusion is done by this middle part, and this is actually most threatening one. But then once you up to the director, principal, managing director, it's the people work. You always need that, right? You can't send a robot, a machine computer to the clients saying we have a talk. So these ones probably don't need. It's this basic, simple analysis that a human does, but can be simplified or programmed. That's the fintech might have some challenge on that. Similarly, in the commercial insurance, same, that's the part. Okay. The investment bank, sorry, this is really old, as I said, it's an old example, but pretty much similar, adding with some basic increasement, right? And you can see like, for example, the executive director, this is base, is this one, but bonus 0. So this could be a person who is this is the name probably tell you as well. The executive director, you can see this is a person, a title created somewhere in between the director and managing director, right? That means he does a lot of executive duties, but he might not bring a lot of profits. That's why he don't have bonus. He has a reasonable base at the director level, and his experience maybe qualify him better than the director executive, but he might be in a division that are not bringing profits. That's why he could. This is my guess based on this, which is what you see here, right? And then if you look at this associates, right? Even though he is, sorry, I'm keeping doing this. Even though he is only a second-year associate, and his base salary is much lower, but he is probably in the maybe IPO division or merger acquisition division that brings, or trading division. It could be in the trading division, bring a much more profits that's higher bonus, right? So his total compensation is actually much higher than the director, even though he is only a second-year associate. Right, and then we can look at this very high one, Credit Suisse. He is at a sales and a trading high performer, so that tells you a lot. If he is on the sales and the trading, these are the divisions that can bring profits a lot, right, have high bonus, and then he is a high performer, and his level is managing director, right? So as managing director, see his base may actually pretty much similar to some of those directors or other managing directors. So if you're looking at a managing director and the executive, they are similar, but the problem is whether they are on the, right? So this one is a high performer, so he has a huge amount of bonus, right? And this is, then the total compensation is much higher. Then this JP Morgan, since he is a group head, right? Higher base and much higher bonus, etc. Does it give you any sense, some sense of the basics? Okay. I hope it gives you some incentive to study hard. Anyway, okay, so this is the investment bank. Now the money management. Money management basically comes to mutual fund, pension funds, like and or venture capital, hedge fund, etc. Right? Now the money, so the salary is likely to be always have a bonus, or they usually call it different names. Sometimes bonus, some are pegging, or whatever name they're doing, right? But there are many different managers. So they always have a base plus some kind of bonus, right? So for the typical the trust bank, the base maybe is not that high, but then it depends on your performance, etc., and what type of fund you are in. That will create a huge difference in their total. Now, in the equity portfolio manager, there's high dispersion. So, for example, a state pension funds. A state pension funds will be the money is coming from corporations that contribute for their employees' retirement, right? That goes into the pension funds. And those pension funds usually don't have very sophisticated manager. I have to be honest, they are relatively more admin-like rather than active investment. Partly because the pension fund's nature itself that limits them to trade too aggressively, right? Because they have to control risk. It's the retirement money they're looking at. The second one is because the state pension funds often will involve a lot of relationship, right? And then they can't manage it. And the corporations, the local or the business chambers, etc., can have a tight relationship with them, then they have influence on the management, right? And the corporation CEOs may not understand the portfolio management that much, but they are not willing to give up their influence, right? That will further limit those portfolio managers' ability to manage. Or the manager might be there because those people trust them rather than the high skills, right? So that's why they're often paid relatively less, only 90,000 to 180,000 range. But if you go into this private fund money management, then they can become increasing much fast, right? And so this is often goes into about $500,000 if you are a reasonable size of mutual funds and then doing relatively well. Now, in this, I would like to, so sometimes there's a title inflation that's almost everywhere. For big funds, for example, Fidelity, it's probably the largest mutual funds in US, right? They have over thousands of mutual funds. But they also have some funds that actually do not do investment. They sort of receive the money through the clients, but then their only decision is where the active manager funds, those funds is going to be allocated to. And those managers sometimes like to have a title inflation called their mutual fund manager as well, but they are actually not exactly mutual fund manager. They're, in terms of their skill level, they're probably at max pension fund manager, more likely like an associate or VP in an investment bank. They know the basic of risk return and this client's preference. Therefore, I'm putting the client's money into this fund or that fund. Question?
Will the DB fund and DC fund influence the management?
What fund and what fund?
DB and DC for the pension fund.
Okay.
Will influence the salary series?
I don't have anything to think they particularly influence. I mean, because in the US, the defined benefits are mainly in California and a couple of other states. They are all pension funds, so it's not too much variation there anyway to start with. Yeah.
I just think maybe is there any correlation between because nowadays the trend of the fund will become the DC fund instead of the DB fund. So this will be influenced by the salary.
I don't see a clear reason they should be influenced. Yeah. And also defined benefits is a trend that's dying out. Even in Australia, it's phasing out. Yeah. Okay. Then the hedge fund is probably the highest ones of the all because of the profit sharing much more, right? And the some of the fund also difference is whether you trade a fixed income versus trading the equity. And then there's also the closed-end fund and the open-end fund. Again, the closed-end fund might be slightly lower than an open, but that is all have to be based on similar fund size, similar location in the country, right? Because cross-country, cross-region, there will be big difference as well. I see some examples. Hedge fund is highest. So this is again 2008 earning. That's the highest was 2.5 billion in a year. That's way too crazy, right? And so this is a hedge fund, right? Because the hedge fund, the reason the hedge fund can go highest among all is they taking. Okay, they would say it's more risky, but I don't think I have time in the class to illustrate you any hedge fund trading. Did we talk about this before? Well, if you really understand, the trading is not that complicated. You guys actually already learned the basics. For the hedge fund, the trick comes of the leveraging, right? They usually have very high leveraging, and then they also have very high sort of profit sharing. They have something called a watermark. Once you're above this watermark, the fund manager is taking the majority, right? So that's why the hedge fund manager is the highest. And thinking about the leveraging, they can amplify the returns. And so these are some of these. So they typically, of course, those are the bigger ones. These are probably the biggest one in the US. There are also a lot of small hedge funds. Now, to run hedge fund, the trick is raising money, right? How do you convince people to actually trust that large amount of money to take that kind of high leveraging risk and then trades on the market actively, right? That's where the trick is. So often you will see the hedge fund manager usually have a particular type of background that gives them the advantage of raising money. Now, there are also small jobs in the hedge fund, and they are still paying very well because of the nature, right? So the founder head, portfolio manager, right? We can skip that part. More reasonable for the entry level, you could start with analyst. But even the analysts in the hedge fund, they usually need some experience to start with. Once you already worked in maybe in mutual fund or a commercial bank or investment bank with quite good understanding of particular financial markets and the industry, etc. Right. So then they have the analyst or sometimes risk manager or the oversight of the risk side, and then the junior trader who are often execution of very almost routine of trading. For example, how many of you have heard Farmer-French factors? Okay, so the Farmer-French factor is sort of a model, can we call it modeling or equation that shows the certain firm characteristics can predict return. But this strategy works only if you have to group the portfolio of the similar firms together. It wouldn't work if you trade one company or two company. You actually have to short a group of firms and buy long another group of firms. I'm just using one example. This is the equity part, right? And a junior trader can be executor of those trades. And those type is once they will have the program running showing that, okay, this group of company now enters this portfolio, and if I do this portfolio this way, it gives me a profit. So they're long and shorts, right? And those are very kind of almost a routine execution or application of the model, then based on what the model predicts to execute the buy and sell. And this is also the part of the job that the fintech can threats, because the computer can do this much better. And even currently before that, it was done, analysis mostly done by computer, right? However, it wouldn't die out completely because the model is built by somebody, right? And Fan French was a professor who, where they are? One is at Chicago, one is at Harvard. And then they have the model, but in the reality, when the hedge fund applies them, they have to do adjustment. And those, you actually have to have a person who are able to do it, right? Until they figure out this model now is working, then they will write a program, they let the computer now to execute. But after a while, when you keep doing this, many people doing this, what happens? The profit arbitrage will go away, right? Then they have to readjust. So there will be still a job here by guiding the computers, right? Or adjust the programs that the computer is going to working on. Okay. But of course, the AI might be more advanced, start to learn the adaptive things, and that's another challenge. Okay, so these are the hedge fund. Then compensation in the private equity. Remember the financial institute private equity? They basically have venture capital funds and leverage buyout funds, right? Now, the private equity funds, first of all, you might have heard a lot of people saying the private equity is making a lot of profits, etc. Now, how does that work? We know that when they invest in a new startup, a lot of new startups will die, right? That's the reality. And why is the company investing in the VC investing in new startup actually making profits? The way they do is because they invest in many, for each portfolio, they will have many companies in it. What they want is one of them, if they can succeed. And then they bring that company to IPO, exit, right? It will compensate the loss of the other firms in that portfolio, right? So that's why what you observe is the final survivor, right? And all the average out of those die out of the died ones, right? And so through this, so the private equity manager, which they usually have general partner, and a partner, usually the general partner might hire a manager, or he himself is a manager. The compensation scheme on the private equity is also called, do they call it a pegging or something? The carried interest, yes, they call it carried interest, right? So basically it's also, again, for each participation, the general part, the limited partner who put the money into that portfolio will take a certain profits of the portfolio performance, but the manager will take a portion of all the portfolio as well, performance as well. That's why it's and they usually can make pretty much once they, as good as investment banker, or the good ones might be like hedge fund. Yeah. So that's the compensation. In private equity, then again, I didn't say each particular job, but you can imagine they would need analysts, particularly the analysts who are knowing some industry very well, particular industry. So you often see when the juniors moving their job, there's a lot of movement between the investment bank analyst and the private equity, because they are very similar. They want this analyst to be really good at a particular industry. Okay. And then real estate, right? That's be residential property manager, real estate agents that do the sales, analyst only decides whether when it's good to enter market, the analyst enter market or where. And then the project manager and the mortgage lenders, etc. These are the rules. Now, finally, the corporate finance, and this is probably the least exciting one because of the relatively lower salary you can see, right? So it's like, but this is actually giving probably a lot of job. It will be in that because every corporation is need someone to take care of finance, right? So the smaller firm, much smaller. But in the corporate finance, if you go higher, and you can go in the end at the chief financial officer, right? It's actually pretty good as well, because even at the smallest one, you go about 110, but for the big ones, is the chief financial officer can be very high. Right? This is for smallest company. And for the small company to get into chief CFO, it's not that hard. It's the big company CFO is going to be very hard to get to. Okay. And that's what any other. Then there's a lot of job of just doing the accounting and the treasury at the corporations. But these are not that demanding. Okay, so any questions on the career stuff you want to ask? No? Okay, if not, we will stop this one here, and I will start with the next lecture. So many of you want to go working for the investment bank or hedge fund, I guess. Okay. I'll move onwards to week 9, and because I think week 11 or 12, 11 particularly, the amount of content is not exactly fit for each class, so we need to go a bit early. Okay, so we continue with lecture. And then recall what we talked last week is about neoliberalism, right? And the neoliberalism, one part of it is about the state privatization of state companies. And so this class, we're going to talk a bit more. And particularly, we're going to talk two things. One is the state ownership of corporation around the world. That sort of reinforce what we have understand of the state ownership and how the things. And the second part is sovereign wealth funds. Of course, today we are not going to be able to finish all of them. This majority have to leave to the next class. Did I? Yeah. So this is actually starting with, is this big enough? How do I make it bigger? How do I make it bigger here? Okay. Okay, so this is a corporate ownership around the world. So basically for each country, right, they're going to, this is based on listed company, they're going to looking at, how many percentage of the companies are widely held, means there's no significant controlling shareholders. And this is using 10% cutoff. If you have, everybody is below 10%, it's widely held. If you have one family owns more than 10%, it will be categorized as a family owned. right? Or if the state owns 10% or more, it will categorize as state. Right, so then they put the category here. Now looking at, then this is the legality. We can look at Australia, actually. So 55%, or half of the Australia companies are widely held, right? And about 10% is family-owned, 5% is state-owned, which you can see a lot of aviation company, energy are state-owned. And widely held by financial, that means the majority are held by like portfolio manager, mutual fund, etc. Or widely held corporation, that means the other corporation as the majority holding the majority, or the other mercenaries. Right? So this is in Australia. This might look surprising to you. About 5% is state-owned, and Argentina has 20% state-owned. Norway, Singapore, Spain, they all have like 40-45% of state-owned. So it's not just Asian or China has state-owned or Indian. It's a quite wild phenomenon. And in Austria, how do I move this thing away? How do I move this thing away? Okay. In Austria, 70% are state-owned. Right? This is almost as high as China, Right. And so this, and then going further down, it's actually very common for, Germany, France, Greece, Israel, and Italy have 50% state-owned. Right. So this is just show you. So state ownership is not a unique in China or in Asia. It's very widespread in the world run. Now, but we have an impression or misunderstanding, I'm going to say not we, people often have, thinking outside of China, they are widely held. This impression is usually coming from US, because US has been right. And if you're looking at the US, 80% or UK, 80% and 90% are widely held, 0 state-owned. Now, when they say 0 state, I don't think it's exactly 0. They can point to 0.0001 maybe there, because like, for example, Fannie Mae, etc., they essentially have state ownership behind. They don't exactly state owns it, but the state has preferred shares. Okay. Right, so that's because the people are looking at more at the US, then they have the impression as if the US is model. And if you're looking at this whole table comparison, you will find who are actually the outlier. It's actually US, UK is the outlier, right? It has very high percentage of widely held companies. Okay, this is one phenomenon that I'm going to show you. Okay, next, how do I make smaller then? How do I make smaller? Where is the thing that I could look? Okay, here. Okay. Now, why are they state enterprises, right? Because this is so widespread. And then, as many of you was always hear about the criticism that state-owned is bad, but why? They're so widespread, right? Now, in the socialist economy, the state ownership is a norm. Like China, Russians, or East European, and even German, like social, they are. So it's a norm, but in the socialist, then you have the socialist capitalism or the socialist planned economy. Now, for China, like 40 years ago, it's a planned economy where the government don't use market at all. The central planner allocate all the resources, right? So that's one extreme. And another extreme is the market, then everything is using the market. Nowadays, the social economy is somewhere in the middle. They have the state planning, then they're also using market. So that's why you will see a lot of state ownership survives there. So then what is the role of the state enterprises in the market economy, right? There's somewhere in the middle, it's actually the norm around the world. And so so one reason they could be good is they can operate in the region or in the firm or taking the projects that the private company are not willing to take, right? For example, the public project, sometimes infrastructure, right? Building roads. Building roads is a big, long project and a lot of investment. But unless you make the road as, you know, they have people take the road, have to pay the toll. Otherwise, there is no profits coming out of it, right? And in that situation, you would need a state-owned company to come in. Or if not a state-owned company, maybe some kind of government support to come in, right? And one thing you can see in China in the highway development is a lot of highway was contracted to a private company, or actually it's not exact private, sometimes it's a state-owned that company. And then once they may issue bond to help with the construction of that road, and afterwards, some of the highway may charge tolls, right? And as a profit that coming back or pay back the state, etc. And so this is, or utility firms, or railways, highway, right? That's one area. Another area is to mitigate market failure, right? And the market failure could happen for example, the industry is not mature, that the competition might not be normal, and you might have monopoly, or the nature of the company has monopoly. For example, network. Phone network is something, or even the computer, software you use, like Windows, etc. The network effect gives a nature of this industry ends up with a monopoly, right? For example, if you're using phone lines, right, you can't have too many phone providers. You might have 1 or 2 or 3, but not too many, because then they can create the barrier between the network providers, right? They can provide, I don't know whether it's in here available in Australia. But in US, for example, if you and your friends are in the same network, say it's all provided by T-Mobile or AT&T, if you're in the same network, you have free calling to each other. But across the network, you would have to pay. And what this creates, it's a monopoly power. People would prefer to be in the same network, right? Now also, computer, Windows, right? Why there's only Windows and Macintosh 2 left? Because the network, right? You work on the file on Microsoft Office, and your partner or your collaborator or your team member, it would be much easier to use the same software to read, right? So because of this product nature, there could be monopoly. And if you let the monopoly to be a private company, it's usually not good for the consumers, right? That's why Microsoft are often being sued as a monopoly, and they have to pay a lot of profits out. And then the phone network or the gas provider, etc., all those things, right? So those are where the market fails. So then you need a state-owned company or the state to step in. Now that's the reason we need it. And then as we told, right, so in the past 50 years, the neoliberalism is accusing the state ownership is inefficiency, etc., which is true in certain areas. Then there's large privatization going on around the world in many countries, right? And we talk about the successful one is the UK's Thatcher's government program in the 1980s, right? And they reduced to 10% of state, before they don't only have about 10%, to almost 0. They even privatized the telecom company or utility or the water company, etc. So that's most, right? And the French privatization takes on the 80s and 90s as well. And then in Asia, there's also a lot of privatization with railway, etc. Right? And these are the example of the successful privatization, right? So if you take, how should we say this thing? Japan's economy history is also interesting too. Too much, but don't have time to talk about detail in Japan's, right? But in general, we know those tele company, etc., is better to have, or utility, they are fundamental to the society, that's better for or easy for the state. But if you have proper arrangement of that ownership and the regulation with the government, they usually works as well, right? For example, in US or UK, essentially, their gas company or utility company are privately owned, but they are subjected to the government regulation of the price range they can charge. And then they also have the different, for example, the gas company have to build the pipe, right? Then they have to have the land usage rights to build those pipe along the line. This, again, through those, government can interfere, and the government can put them back into the place if they sort of doing way too much profit that threats the stability of the economy, right? So through those all kinds of arrangements, they can create a balance of the power to make sure the private company can work properly. But for majority of those companies around the world, they are typically owned by the state. Now, why do government privatize SOEs? One reason is to raise revenue for the state, right? If you privatize it, that you don't, because it doesn't take the burden of the physical expenditure, or if like China, if you're doing partial privatization, right, they can still own those assets and they can take in dividend or etc. In China, there's a state assets bureau that manages the wealth of the state. The second reason is promote economic efficiency, because the state-owned companies might have political goals, etc., or the managers might have different goals. It might be solving employment, so it might not be run efficiently, right? Reduce government interference in the economy, or provide the wide share ownership, right? So that way. So what does this mean? Promote wide share ownership. It's basically the economy or the other consumers, citizens, or investors on the market have the needs to invest their funds, right, where they could invest through stocks, right? And then privatize some of the SOEs, say you privatize an energy company, which is usually not available for the investor in the portfolio, now become available, right? They can diversify their investment, right? That's the wide ownership from the investment point of view. For the company point of view, if the company are having wide ownership instead of just state, they can allow mutual fund coming in to take ownership, or they're allowing other corporation or the individual coming in to take the ownership, right? So on the shareholder meetings or the voice of the shareholder needs, now you have diverse opinion. Then the decision of the company have to consider the overall shareholders' objective, right? So that will give more disciplinary to how the company is run or operated. And it can provide opportunity to introduce competition. That's, again, we talk about the monopoly competition. Then a subject SOE to market discipline. Right. Now, this is one example. What do you mean subject SOE to market discipline? If the company is fully owned by the state or more than 50% owned by the state, then even if it's run poorly, what is the stock market able to discipline it through merger acquisition? Not, right? Because the state is controls the majority. But if you privatize the company, even if you're not fully privatized, say now the state only owns 10% or 20%, and if it's inefficient to run, the market discipline will work because the other corporation may take over it, right? If they buy enough shares from the market, then have an ownership larger than the state, then they can have the more dominant thing in terms of how the company should be operated. Right. So the stock market, one of the stock market's major role is through the merger acquisition, they can discipline the companies. Right? Then inefficiently run corporations will be bought over by the other companies. Now, privatization in China and India, we sort of mentioned a little bit when we talk about China, right? Now, this is called a socialist market economy that in China was adopted in 1992. So this is, again, because where your background comes from, you're thinking this is unique to China. It's not. From the economy point of view, China is not so different from other countries. Like Germany has always been the social economist, social market economy. The difference is mainly in the political system, then that large influence. A lot of the orders are used to interfere with market economy. That's what it's different. Okay, and then after 92, and you also know that is the time China's stock market is initiated, right? And through the Chinese stock market initiating, the major law of the Chinese stock market is actually to privatize SOEs for a long time. The majority of the firms that are listed are the state-owned firms, and they do partial privatization, right? Certain percentage of shares to be sold on the market. Do I have a table? And I don't have a table here, right? So only about 30% of the listed company shares were sold to the publics. Other about 60 or more than 60% are owned either by state or the founders of the companies. And for a long time, those shares even could not be traded until a bit more than 10 years ago. They reformed to make all shares tradable. Right. And then and some of you might heard from maybe almost your grandparents' generation, right? So before those happens, this SOE in China has a lot of social responsibilities. The company would have to take care of the retirement of the people. The company all have housing for the employees, right? The company will have, all kinds of, I don't know, they interfere way too much of the thing. And the housing, then they often have school. They might even have hospital, right, themselves run in. It's like a small society runs in the corporation. Now, then for Indian, the Indian independence gained independence from British colony in 1947, right? And the India adopted a state-directed economic development for 40 years after the independence, and then started the major economic reform and liberalization in 1991, right? And both in India and China, before the performance of the SOE is very bad before the privatization. Now, for Indian situations, we already mentioned that in early, maybe week 4, I forgot exactly which week, or week 3 or week 4, right? So this is a very interesting country. It's colonized by British. And then the British installed or established all the institutions or legality in India, like in Britain, right? And so they have very, full system of parliament, court, all those things in place, just like in Britain. And after independence, they didn't disappear. They were there. But in the economy, the Indians started to actually take the state ownership majority, right? And then they run for 44 years, doesn't work. then they start to switch to the market economy, and where you were supposed to expect the legalities of stuff installed in Britain should play a major role, but it actually did not because of the poor enforcement. And this is everybody sort of acknowledging that. Even our Indian colleagues were saying, I heard a story the similar story from many, many people. They were talking about they travel to Beijing and see from airport to the hotel, they see one project was being doing it. And then he said after a week of business trip, he comes back, it was finished. And then he go back to India, and he said, I will pass after this intersection, they were building a lights or something. He said, I went this year, it's there. Next year I go, it's still working. They're still working on it. So they looking at the difference of how the enforcement of the efficiency makes a huge difference behind why China's after 92, this market economy can kick off so fast while India is like behind. And this is a very interesting part of, from the conventional point of view, India with this legal protection or the institution built by the British should actually do better than China, right? And this is exactly in China, it's maybe the market, it may be the state, make it actually work effective. Okay. Now the privatization, right? So this is how the privatization is done, right? So we know to privatize to expose to market force. The typical done is, particularly in China, is through share issue privatization. So they sell part of the company as the shares into the public market. At the same time, the state still maintain a partial control of the firms, right? And this becomes the interesting part of, now do we see government as a regulator, the policymaker, and also the owner at the same time? Or we just see the government now as an owner, right? Because this will be the conflicts of interest compared to the private firms, right? If the government is just the owner, then you will not be expecting the government to implement a policy to favor the state-owned firms, or even they're partially controlled, right? They were just as an economic participants, as an investor who holding certain assets, right? And this is probably the biggest difference between China's social market economy compared to, for example, Germany's social market economy. Because in China, we do see a lot of policy was created a preferential treatment to the state-owned firms. Okay. And so when China was talking about a lot of reform, this might be about the side. So this problem was, how many of you know Hu Yaobang? Hu Yaobang? Okay. Not politics, it's just the economy, because he died before the 1989, right? So in 80s, China haven't do the share issue privatization, right? But there's state-owned company, and then they start to run private company, right? Remember, for after 78, China starts to allow private ownership, right? So many of the private firm comes in. And at that time, the central government, which at that time was under leader Hu Yaobang, already sees the problem I just said. Does the government just come in as an owner, as an investor, or as a policy maker, right? And at that time, the policy was already proposing in 86, because I do this type of research, and in 86 or 88, they already had this proposal of to force or to ask the central government to make a clear, they call it maybe law or something, to make it clear the government should participate on those corporations just as owner and investor, not as a regulator at the same time. And he said this is essential to solve the efficiency problem in the state-owned companies. And this one was died out because this, you guys must know, in 1989, what happened, the political turmoil, right? So this didn't get implemented, and instead the policy was revert much back to what's called state advance, private retreat, the thing, right, the policy. And then even to today, recently, this was briefly mentioned, then disappear again. So I have some certain research, and some others have certain research of looking at China's reform. Is it always going forward, or actually it's going forward and backward? And forward and backward, and sort of iterate process. So today, China is still having, say even after have privatized so many state-owned companies, still have the same problem. How the government to discipline itself to control its regulator role from the owner's role. Now, are partial private SOE more efficient than pre-privatization for fully state ownership? Right? So the major research done, or very famous, is by this William Meggins and Nashik, actually. They do the research from around the world, those share issue privatization. And their basic conclusion is they get better because they're subject to market discipline, right? And then there will be also example, particularly on India, right? So they say once you have listed company on state, you have other investors to come in, the market can discipline the firm. The company start to run relatively better. Okay, they have a positive effect on profitability, productivity, and investment. Okay, so this will be the evidence on the Indian, right? So this first column is the average performance before the privatization. Second column is the after the privatization. Then they compare the difference for the sales and the profits, productivity, and the labor employment. They all become significantly higher after the privatization. And also in terms of the assets growth, the research and development, right? This is all much higher. Now, this evidence is for India, not necessarily for China. And also, there are one study recently showing the privatization in China, also showing R&D investment increase. But there's also other studies arguing it's probably not because of the ownership change, might be because of financing issue. Anyway, okay. Then what is the incentive? So if the state is going to privatize the firms, what is the incentive to still retain some control, right? So one is similar to earlier, why we need SOE, is to help when the market fails, right? And the second possible reason is to pursue political goals, right? Such as social stability, employment, etc., using the invisible hands. And often the status role is kind of looking at as a helping hands and a grabbing hands. Now, what do you mean pursuing political objectives such as social stability, right? I can give one example of, again, you guys know most of the investment company in China are state-owned, right? The investment company or the security company are investment-owned. Now, the security company runs a lot of mutual funds. They call financial institutions, institutional investors, right? And you guys are very familiar with this term, save the market, right? Now, would you see this in U.S. happens? When the market crash, the government orders those mutual funds, now you have to buy. It doesn't happen in U.S., but it happens in China. right? The security companies are basically saying, you have to buy because the market, we don't want the market to crash. And what's the reason? Because those companies are owned by government. The security company are owned by government. Now, is it, as from business ethical, is it a reasonable thing to do? We are differentiate, because it's the mutual fund management are owned by the company, owned by government, therefore government can order them. But from the shareholder interest, because the mutual fund, remember what is mutual fund? They pull the assets from small investors, right? And then they invest on the financial market. So who owns those funds? Who owns this portfolio? The small investor who chips money, right? The government don't own those portfolio money. But the government, because they own a mutual fund company, they're ordering basically this portfolio, what assets you should buy. Whose interest is getting hurt in this process? The small investors, right? So this is another example of illustrating. So the political objectives are being achieved rather than the shareholder benefits once they do this. Now, actual objective state-owned companies, right? Social stability, maintaining employment, strategic industry, which this employment thing, which actually is not doing so much in China. Strategic industry policies, particularly on the innovation. Then the state object may not be the same as maximizing shareholders. That is one example we actually have been showing. But in some situation, this might be overcome if the arrangement is properly, the mechanism is properly arranged, right? And one example, I think, do I have this one? Maybe I have. No. Okay, maybe later on I'll show you an example. Because thinking about what is market mechanism, it's essentially all coming from how you design the market, right? So if you design properly, you could have the SOE run well as same as market economy. If the mechanism design them to have the incentive aligned. Okay, how does government control partial privatized firms? One is by holding a majority of shares, that's EGASCOM, right? By special voting rights, which is create shares that have super voting power. This can be done by state. This can also be done by private firm as well. For example, Jingdong. You guys know Jingdong, right? This is a company don't have one share, one vote. What's his name? The founder's name. He basically himself holding, even though a relatively small portion of the whole company, but the share he holds have the supermajority voting power. He probably holds almost 80% of voting powers. That makes this company is basically run by himself. He has absolute say of the company's strategy. Right? And the government can also control the private firm by sending political connect director, by appointing CEOs or appointing directors, control the staff of the company through this. Right. Okay. And so I was just giving some example of the government ownership and control of Chinese listed company. Right, so for example, this is Zongjing Non-Ferrous Metal Company that is directly owned by the state, or the state ownership is controlled through another state-owned company. So the government-owned legal person, which is like an institution or an incorporation, then are shareholder of the many companies. That will be, for example, the what's called State Assets Bureau, was the State Assets Management Bureau of China, that is existing at the central government, at each local government, and they own the representative of sort of represent state to own these state-owned companies, right? So they basically is controlling the companies through another state-owned institutions. Okay, so this will be one example. Do I have time to go this? I think maybe we maybe we leave this to next class too much, yeah. So this is best, so let's stop here. Next we will continue with how the state ownership is sort of, how it is organized in China, the different way of organizing state ownership. Any questions for today's class? Oh, good? Okay. Very good. So then I'll see you next week then. Why? What is classified investment company?
Open-end
Yes, they are investment company. Yes, but each fund can have many portfolios. And this portfolio itself, to you guys, it was sold as a share.
So we treat the fund as a company?
It's not exactly a company, it's a portfolio.
Yes. So
But an investment company can run many, many funds. It's different. There's a company and there's a portfolio. There's two different things. The company is an investment company. The portfolio is a portfolio. We just said the Chinese government owns those investment company, but do not own those portfolios. The investor owns those portfolio. There are two different things.
yeah, so for the mid-exam multiple choice, and I remember that
When I say mutual fund, it could be the fund investment company, it could be the portfolio.
yeah, but that question is which one is the investment company?
Yes, mutual funds are investment company.
And the open-end fund, and they are also investment company?
Yes.
And it's not treated like a separate fund under the...
They can have run different portfolio funds. So the words of mutual funds is a short. It could mean the fund company, it could mean the portfolio. This was in the slides I specified, emphasized.
Yeah, so at that time I just treat them like a portfolio.
No, if you want to specify it's a portfolio only, you have to say the mutual fund share.
Share.
Yeah, or the mutual fund portfolio, something like that.
Thank you. And about this lecture, did you say that the partially privatism is compared to this total widely held company? Did any research to compare this to like efficiency or?
There's almost all the research wants stuff that has those comparisons. Yeah, from all the angles. Right. It's very common. Yeah, when they do research development, when their performance, they compare them. Yeah.
widely held better?
Not necessary on a different situation. And the different situations, some might be do differently. Yeah, thank you. You can if you wanted to, but that's more like a brief description. Provides background. Yeah. No, this is just background. Background is description, not your analysis. Yeah. You can use those information into your analysis. Yes, you can use a lot of information to lead to logical, conclusion or statement. You should start with, now you forgot, you are mix of everything. There should be a report description analysis. Yeah, you should start with an executive summary of showing what's your business plan, and then detail this into this. Yeah. This is not. I'm not telling you this background and what you should put in the report. I'm introducing you the case. Yes. Exactly. These are the questions you need to consider, and this is structure of report, and this is objective you want to achieve for the report. And this background just introduces the project.
You need to pick some questions, or all those questions you need to explain.
Why you for the best achievement of your objectives. Yeah. That should be the key part of your business plan, is what the case does. You can choose a focus, so you can do both, up to you.
This model includes ownership, product, and service. What's the model?
The business model is that's much more comprehensive than P2P. It's basically means how it works. How it basically how it works, how it is organized, what product then you get in how you get profits in this. Remember how we talk about each, the bank and the insurance company how they work? I just have each very briefly one line to talk about each, but that's basically what you need to consider.
So the P2P is just something like a service or product.
Yeah, the P2P, it's basically only talks about the organization of